Today there's a lack of traction in the market for a good part of the year, though. We've seen a lot of complacency on virus concerns, on stimulus. Is that the theme going forward?
I think there's a lot of confidence regarding a vaccine rollout. I think markets are assuming that this is going to resolve the issue. There are some tail risks involved there. I think that there is a chance that deployment of a vaccine could be delayed beyond what markets are expecting. But in general, I think that the picture is pretty positive. I think that we've got some very good vaccine candidates with extremely high efficacy rates, and that will likely lead to a resolution of the pandemic. It's hard to bet against markets given all the strong fundamentals in other respects.
But you have herd mentality right now. Even retail investors are getting in on the act. A lot of money going the same way, and historically, that always leads to a sharp sell-off. Are you expecting that sometime down the road?
I don't see much issue in Asia as far as crowded trades are concerned. We've seen an improvement in market breadth over the past month or so, ever since the U.S. elections and the Pfizer and Moderna announcements, whereas before we saw all of the activity, all of the buying in the growth stocks, particularly in tech. Now we've seen some rotation into cyclical names like banks and energy and real estate. So I don't think that we're really at risk from crowded trades.
Dan, and in fact, your favorite sector looking at next year on a country level, that is Hong Kong real estate. That's interesting. I can see the valuations being compelling. What's the premise there?
Well, I think real estate in general in Asia is a good story for next year. You've got pretty ideal conditions at work. You've got very low short-term interest rates, and banks in Asia tend to price mortgage loans off the short end of the curve. You have an improving economic outlook, and you've got tremendous excess liquidity. And in Asia, when you've got excess liquidity, it tends to find its way into the physical property market. So why Hong Kong more than, say, some other Asian markets? Because you've got less policy risk in Hong Kong. Hong Kong government tends to take a pretty laissez-faire approach to property, and there isn't much risk of macroprudential measures to try to suppress activity in the physical property market.
Yeah, fair enough, Dan. So let's attach an EPS projection from your end to this recovery. What are you guys looking at as far as Asia ex Japan is concerned? And I guess does that then bring down those multiples that are pretty much a little bit high at the moment?
EPS growth should be very strong next year. It's working off an easy base from this year being depressed earnings, and coming off actually another year of depressed earnings in 2019 because of the trade war. So we expect that there will be very strong EPS growth. In general, most countries in Asia will be generating something in the 30 or 40% range.
I'm just wondering, you're expecting that earnings super cycle, but that's because of a low base in 2020, right? I mean, there's still questions about how strongly these economies and companies will rebound. Lack of consensus when it comes to that.
Well, there are two stories on earnings, I think, in Asia. Number one, there's the short-term bounce back next year off a low base. That's pretty easy and pretty obvious. But I think what's more important is that we should be seeing better growth on an extended basis. We're coming off a decade of very weak EPS growth in Asia. Over the 10 years from 2010 to 2019, EPS growth was only 4.7% on a compound annual basis. I think going forward, beyond next year, even after that big bounce back year, we can generate growth in the mid-teens. We have a number of drags which are being removed and a number of positive drivers. So I think we're entering a new period of stronger EPS growth, even beyond that bounce back growth next year.
You talked about liking technology. You're also liking banking and insurance. What's the basis for that?
Well, I think some investors believe that you have to make a choice between growth and value. And I think actually you don't. You can have a bit of both and just underweight the defensives, things like utilities or communications. What you've got on the tech side is still good structural growth coming from 5G, from increased demand from hypercenters, from improved inventory levels. You also have on the cyclical side a good story for sectors like banks or energy or real estate from a global economic recovery once the pandemic is resolved. Plus, you've got very cheap valuations for these cyclical stocks, even after the rally they've had over the past month or so.
Dan, as a final question, as we look into next year, 132-page reports, what haven't we talked about these last couple of minutes? What do we need to know? Key takeaways here.
Well, number one, Asia, emerging market Asia, should be the best performing region on the planet this year. You've got cheap valuations, a great growth story, good upside on currencies. Within the region, there's a lot to choose from. It's hard to say which is going to do better than the others, but we're sticking with Korea, which has been our favorite this year. I think that there's still more room to run. The valuations are there. We like DRAM and memory within tech the most, and that's a strength for Korea. And Korea also has good cyclical exposure to areas like autos.